Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, on Thursday, we got the much anticipated new proposal on capital requirements from the Federal Reserve. And I was very disappointed in terms of what the regulators have come up with in here. I don't believe for a single moment that this protects the community banking system. And when you look at it, it might protect somewhat from larger banks, but as we look at in terms of, we'll go through the risk weightings, we'll go through the changes that they're proposing and comment on why I feel that way. They are coming up with a new regulatory capital ratio, which is called the Common Equity Tier 1 Capital to Risk-Weighted Assets. And this is really in terms of any kind of equity exposure that a community bank would have. Say by a common equity portfolio that they might own, is that it's going to have much higher risk weightings, and they're setting that guideline minimum of 4 to 4.5%. This really impacts more larger institutions. But when we put this up against this particular situation, is that this did not cause the community banking failures in terms of this type of asset class. Second, higher Tier 1 capital ratio. This we expected, but only increasing it from 5% to 6%. Once again, this would not have protected the failed banks in here. New capital conservation buffer, 2.5% above minimum guidelines. This is to basically put into perspective the payout of dividends or any other kind of capital payout from net retained earnings. So that when we look at it, the calculation is that if you're greater than 2.5% over the minimums, is that there's no payout limitation. Okay. Then when we look at it, is less than or equal 2.5% and greater than 1.875%, that you're limited to 60% payout of retained earnings. Going all the way down is that if you're less than 0.625%, is that you would not be able to pay out any sort of dividends. So we look at this really in contrast to all of the community banks out there, is that right now their Tier 1 common equity is at 14%. So it's so far above the buffer calculation that would be at 7%. So once again, on the median community banks in our benchmark group, which number about 2,000 banks, is that they are so far above this that it really doesn't have any impact. In fact, when we actually calculated how many banks had that impact, it was 124 banks. Then you look at Tier 1 equity, 14.18% for the national benchmark versus with the buffer at 8.5%. Once again, only 130 banks fall out. Looking at total capital at 15.4, is that then we look at 10.5 with the buffer. Once again, only 159 banks fall out. So the impact of this really is minimal on the community banking system. But once again, in terms of protecting the community banks, this has nothing to do with anything. Now, we look at these adjustments to Tier 1 capital and regulatory guidelines is going to be phased in over several years, and we'll show you that chart in a second. Unrealized gains and losses from the AFS portfolio would be included in Tier 1 capital. This actually may have a negative impact on how community banks run their investment portfolio. The first thing that comes to mind is that would we ever buy a longer term investment like municipal bonds ever again because of its effect now on Tier 1 capital? Once again, you take it out of your equity to asset ratio. So when we then look at it, and now being part of that Tier 1 capital is going to make that Tier 1 capital be much more volatile. Of course, now most community banks have gains in their portfolio which are going to push up their Tier 1 capital. But what happens when interest rates go up? And a lot of bankers will fear that, gee whiz, if I have losses in the portfolio and it affects the equity. Think back to, say, when the municipal bond market was in disarray last year and there were so many losses in community bank municipal portfolios that once again that would have taken Tier 1 capital down. So this has a possibility that this could actually force people to stay shorter in their investment portfolios, take less income. But on the other side, one can look at strategies, and we'll talk about these strategies in some future webcasts in order to protect that Tier 1 capital. Once again, it probably means more active management of the investment portfolio, but my belief is that, once again, as part of your capital planning, that you sit there and create, like the Fed did in the other area, a buffer, and that you don't want to go below that buffer, is that then you put into strategies that'll keep you within that buffer. New risk weighting on mortgages. Okay, think about the community banking sphere. The community banking sphere did not write the type of subprime and unconventional mortgages that the large banks wrote. But now you're going to get nicked in terms of risk-based capital just because of what happened in the mortgage market. So that let's look at, there's two categories. Community banks really write their mortgages in this category 1. The more unconventional mortgages are in category 2. But now you have to go to the loan-to-value ratio. If it's less than or equal to 60%, we now have risk-based weightings that moved up from 20% to 35%. Once again, in my thinking, this is just totally ridiculous, because think about your own mortgage portfolio during this past Great Recession, and think about the level of net charge-offs that you had on that portfolio. And now they're taking the risk on those good prime mortgages and saying they're much riskier assets. In fact, greater than 60% and less than or equal to 80% loan to value now moves up to a 50 basis point risk weighting. Looking at it, greater than 80, less than or equal to 90 takes it to 75, and then if it's greater than 90, it's 100% risk weighting, just like a commercial loan. So think about that and its impact, but think about it in terms of why are the regulators thinking this way, especially if they expect that these capital proposals are going to be put in effect for community banks. You can then also see in this side is that you have 60% less. Now it's 100% risk weighting in the proposal. Risk weighting of non-performing loans, I think that this is a good, particularly, but it really wouldn't have prevented the bank failures, because what comes out of this to get your risk weighting is you have to subtract out any collateral values, that might be any real estate that's underlying it. And so when you look at this, is that the small amount and its effect in terms of risk-based capital, once again, would not have prevented the bank failures. Risk-weighted asset changes are going to go in effect January 1st of 2015 if the proposal is accepted. And then we have the chart ranging from 2013 out through 2019 for many of these changes to come about. So what you want to do as part of your capital planning is to go and get your capital plan and go through it based upon each one of these bullets to see what kind of impact this is going to have on your bank, to put into place the strategies, maybe change in your asset base, etc., as you look at each one of these phased-in capital requirements. And we think about that overall, that I've said over and over, that community banks have been the strength of our financial system, and that with the problems with some community banks that failed in here is that these new capital requirements would not have prevented any of those bank failures. Have a great week. This is Jay Brew, co-chairman of Seafried and Brew.